What is a zombie mortgage? Pandemic-era version. A zombie mortgage is a home loan a borrower believed was paused, protected, or effectively resolved during the COVID-19 pandemic, but that later reappears with full legal force. During 2020-2022, millions of borrowers entered forbearance payment, deferrals, temporary hardship programs, pandemic foreclosure moratoriums. Many borrowers assumed the loan was frozen, the bank handled it, I'll deal with it later, or worse, it went away. In reality, the mortgage never disappeared, it was only suspended. When protections ended, some of these loans quietly reactivated. That's the zombie. How pandemic policies created zombie mortgages. Zombie mortgages surged because of federal and state foreclosure moratoriums, servicers overwhelmed with volume, poor communication from lenders, borrowers misunderstanding forbearance terms, missed paperwork when exiting forbearance. Common scenarios: borrower exits forbearance incorrectly, deferred payments get lumped into a balloon, servicing is transferred mid-forbearance, second liens or HELOCs were never included, borrower moved out thinking foreclosure was inevitable, but it never happened. When the moratoriums expired, the loan came back fully enforceable, often with accrued interest, escrow shortages, missed modification deadlines, reinstated foreclosure actions. Why this hits borrowers hard. Now, many borrowers only discover a zombie mortgage when applying for a new mortgage, trying to sell or refinance, receiving a sudden notice of default, seeing a surprise credit report reactivation, even if no payments were demanded for years. The lien still exists. Interest may have continued, property taxes and insurance issues may have piled up. Silence during the pandemic did not equal forgiveness. What a borrower can do to fix the situation. 1. Verify the current status. Immediately request a full loan history. Ask for the forbearance exit documentation. Pull a title search. Confirm who owns and services the loan today. Never assume the old servicer still controls it too. Review the forbearance. Exit. Terms. Many zombie cases come from missed modification offers, deferred balances, misunderstood as forgiveness, balloon payments triggered at exit. If the lender failed to properly notify or process paperwork, you may have leverage. 3. Negotiate before foreclosure restarts. Possible solutions: loan modification, partial claim for FHA loans, deferred balance restructuring, discounted payoff deed in lieu of foreclosure, short sale approval. Pandemic era, loans often have more flexibility than older defaults. 4. Challenge errors and standing servicing transfers during COVID were messy. That creates incomplete records, misapplied payments, improper notices. These errors can delay or stop enforcement and improve negotiation power. 5. Act early. Zombie loans. Get aggressive fast. Once foreclosure pipelines reopened, servicers moved quickly, fees escalated, timelines shortened. Early action. More options, delay, fewer exits. Bottom line: a pandemic-era zombie mortgage is a loan paused by COVID protections that later reactivates, often unexpectedly and aggressively. The fix isn't fear, the fix is verification, documentation review, and strategic negotiation.